Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel and Escape from the City on the ABC. And Ben Kingsley, Chair of Property Investors Council of Australia and the founder of the 2018 Property Investment Advisory Firm of the Year.
All right, folks, you're on the Property Couch. Each week, Ben and I bring you the insider's guide to property finance and money management. Mate.
Hello.
Welcome to the couch. How are you, mate?
Yes, no, just a little nasally.
A little bit nasally, but still going to soldier on. So,
man cold.
Is that because you stayed up last night to watch the State of Origin?
How good was it? It was terrific.
Nice little decider.
It was a great decider, one of the better ones. So congratulations to the Blues.
Blues, New South Wales.
Got the job done.
We are Queensland.
Yes,
we both lived in Queensland.
We both lived in Queensland first. Yep. I lived in both places, but yes, no, Queensland.
But a shout out to Damo in our office.
Yes, he'd be happy. Brian's not.
Brian isn't. Damien is. So well done to New South Wales. There are probably maybe a few sore heads on this morning. Maybe,
and how to say we're deflecting from the AFL because we don't really want to talk about Freo or the Pies, do we?
We don't. So let's move on.
Let's go straight to the
footy tips winner, Beachy. 7 tips, 7 out of 9 with a margin of 1. And I had a special request from Ibis this morning to not talk about the fact that I have overtaken her in the tips. She's not doing so well. She's had this huge pride around the fact that she was beating me.
How much
she no longer is.
So now I'm going after.
She's no longer beating me. So she asked me not to say anything, Ben. So we're not going to talk about that. Okay. So a couple quick things. Facebook Lives.
Yes.
I did a couple this week. We recently did one with Nerida, which was lots of fun. I did one with you, Ben, how to get your kids on the property ladder.
Gee, that's right. I can't even remember that.
I saw the look on your face when you went,
Yep.
I hope you're going to talk about it because I can't remember.
Yep.
And then I did one during the week with Jane Slack-Smith.
Yes.
And it was a really good framework on mentoring and why some people, Ben, will actually take action and why other people's won't. It was really good.
Okay. So I have to check that one out.
Should check that one out. You were on Studio 10, so if you want to go to our Facebook and have a little look at that, you could see that. You were amongst the morning TV set, mate. How was that?
Interesting. Yeah, and there's a little studio audience as well, which is quite interesting. I've never been... Big set.
It was like a tennis match for you, wasn't it? It was side by side, listen to everyone.
Yes. But it just also highlighted how much people don't know about what's happening in the apartment space, and so that's what we're going to spend a bit of time on today.
Which is the segue for what we're going to talk about today. A couple of other things before we get there, Ben. Susan Alberti last week.
Phenomenal.
The amount of feedback that we've got, I've got text messages, I've got conversations with people, I've had people email out to me. People emailed Susan, Ben, at her medical foundation to say 1 hour podcast transformed me. So if you haven't listened to last week, we put it in our top 2. For me, meeting Jan Summers, meeting Paul Clitheroe are in the top 2. Susan may sneak in there, Ben.
Well, just her story is amazing.
It's amazing. So if you haven't listened to last week's, go and check that out. It is one for the ages, and it will... You will absolutely love it, so go and do that. And you can also go onto our Facebook page. We've got an opportunity to win her book. Once you've listened to it, go on there, give us some feedback. What part of her story, and there's so many parts, made the most impact on you? Go and a chance to win that. We've also got on Facebook, Ibis has put 2 new thumbnails up, Ben, of our podcast and We Other People's podcast. So we want you to vote. Let us know, give us your feedback. We're in the final tweaking stages.
Are we?
So we want to know which of those 2 versions you like, or if you prefer the original, let us know as well. But go and check that out. And the last thing, I've got a little bit of a favour to ask of our long-term listeners, Ben, not the new to the podcast, the long-term listeners. If you've actually had some benefit from listening to our podcast, we'd actually like to share that with other people so that we can grow our community and hopefully help other people benefit from listening to the podcast and implementing it in their own life. So, for those people who love to do selfies, Ben, I'd love you to grab your smartphone, whether it's an iPhone. I'm agnostic on it, Ibis. You can use your Android as well. What I'd love you to do is grab it, do a selfie, and just do a 60-second or less, and just let us know what the difference it has made to your investing by using the principles and listening to the philosophies of what we've talked about. What it was like prior to listening, and what it's like now that you actually have benefited from those frameworks. So we would love to hear that,
Yep.
but we'd also love to share it out and see if we can grow our community a little bit, and that would be really helpful. So if 2 or 3 people put their hands up and help us with that, Ben.
Brilliant.
Send the video to Sticky, info@thepropertycouch.com.au, and we would love to do that, and it would be very much appreciated. I know you didn't know that until now, but it would be very much appreciated.
Well, that's the transformation story we'd like to share.
We would love to share the transformation story. Well said. Hey, my Mindset Minute theme today, Ben.
Yes.
We went to ARIC recently, the Australian Real Estate Conference, and there was a guy there by the name of James Clear. He was the final speaker on day 2. And for me, some amazing speakers. A couple I've got lined up to come on the podcast, so stay tuned for that.
Looking forward to it.
But James Clear had a dramatic impact, because I'm all about little incremental. You are the product of the daily little habits that you do daily. So I took a couple of quotes from his presentation I want to share with our community, because I think they're really important. Number 1, habits are the compound interest of self-improvement.
Yep.
2, if 1% changes matter, why don't we make them more often? He posed that question. So if you're struggling to improve, the problem isn't you. The problem is your system. You do not rise to the level of your goals, you fall to the level of your system. It's all about alignment between your desired outcome, and here it is, folks, and your daily habits. Now, that was from James Clear. Now, I recently reached out to him as a result of seeing that. James has agreed to come on to the podcast, which I am really excited about. He's based in the US.
Best-selling book in this area.
Atomic Habits. Yeah. So what we're doing is we've agreed to do the record a little bit later in the year, and then we're going to release it in January, Ben, because this stuff is going to make a huge difference to people as they set their New Year's goals and set their year up for 2020. So habits are the compound interest of self-improvement. If 1% changes matter, why don't we make them more often? If you're struggling to improve, the problem isn't you, the problem is your system. You do not rise to the level of your goals, you fall to the level of your system. It's about alignment between your desired outcome and your daily habits. That's James Clear. So folks, have a think about that. What are the simple little things that you could be doing daily that allow you to get to where you want to be? Because monumental changes don't happen in monumental stages, Ben. They happen in very small increments on a daily basis.
Now, Bryce, if I could segue that to money management, that's why we have a money management rules-based system, as opposed to just having a budget or some type of theory around organise your money into separate jars. It still has to be supported by a system that's rules-based, because if you do that, you fall as low as that.
I was going to say, you do not rise to the level of your budget, you fall to the level of your system.
That's right, and so if you've got a great system, the system will trap that surplus for you. So nice little segue.
Yeah, I like it. So folks, we're going to talk today about the topic around, should you be considering buying a high-rise apartment in the wake of some very high-profile issues with Opal Tower, Mascot Tower, also the cladding that was on fire in Melbourne in Spencer Street.
Yeah, so La Crosse and also Neo 200 buildings, those fires.
Is the Spencer Street one?
Yep, that's the Spencer Street one. So yeah, it's been some challenges here, and it's getting more airplay. So I think it's important, because we're on record as, we haven't deviated one bit from the fact that we are challenged by the returns that you get out of buying those. And there's some further challenges, but some people are going to want to live in these things, Bryce. In fact, it's now 1 in 5 Australians are now living in apartments, and that's up from 1 in 7 from the 1990s. So I think it's really important that we also give people some frameworks, some information that they are going to need to make an informed decision when the risks, as we are starting to see in Mascot Towers and also Opal Tower, those types of things, when it goes wrong, it can be horrible.
As you say, Ben, I read a book called Homes in the Sky. I can't remember the authors. Caroline is one of them. Very, very good book. It was a history of apartments all across Australia since even back to the Macquarie Fields scenario. And the authors of that book quoted 1 in 3 in Sydney, 1 in 4 in Melbourne, 1 in 5 in Brisbane. So I'm sure that's that book was
and that's a national stat from Census 2016 that I quoted as well.
So we really want to talk about has the landscape changed, and what should you be considering if you are considering a high-rise apartment? Because some of our team here, Ben, live in an amazing building here in Melbourne that's got epic views. Eureka Tower, that's high rise. So it's not just about a conversation around investing, it's a conversation around people who are going to live there, whether it's someone who owns it or whether it's a tenant. And of course, the challenge of late is the fact that safety's at risk because they're having buildings that are being abandoned and buildings that have, evacuated, and people no longer being able to stay in their homes, which is not only providing a challenge for a roof over their head, it's also providing a challenge for how do you solve the problem? Because, I don't want to live in here anymore, put it on the market. Well, you've got a challenge with resale.
Now, we also need to note that there are obviously an enormous amount of apartments around. So we've got over 2 million apartments across Australia. In the past 10 years alone, Bryce, there's been 690,000 new apartments come online, and the actual pipeline of work is 151,000 apartments that are being built. So there is no doubt that more and more Australians are going to live in our biggest cities in apartments. So what are the three biggest problems that we have, Bryce? What are the big ticket items that we need to make sure that our community is aware of?
Well, first of all, structural integrity of the building. That's the big one, and that's why you've got all of these high-profile stories around those buildings right now, because you want to be confident that not only are you in a building that is free of informal or sort of cursory defects, but major structural defects. That's the number one. It
is, and I think it's really important. I mean, probably the first two we'll talk about are the big game changers in regards to if you do have, really major structural challenges, you can see what happens. You will be removed from your apartment block. And that is just, it's rare. So we've got to also understand statistically in terms of the number of people that are being removed from their apartment buildings is minute. But it obviously makes for good news, and it's a good news story, right? Well, not a bad news story, but it makes for good news fodder. So that is the big one. So the structural integrity of the building and how well that's put together and how that process takes shape is really, really important. And what we have seen over the course of the last decade to probably 15 years, we did see a significant change in the way in which apartments were approved and developed. So I think it's important that we do a little bit of a backstory in regards to what that looks like.
I was going to set that up too, Ben, because for a lot of people who are listening to this and they live in a house, they go, why does this even matter to me? And so what we're going to show is a story arc that actually flows onto the economy, not just people who are in that segment of the marketplace. So if you own a house, you have no desire to have a high-rise off the plan or high-rise existing property, and you think you want to switch off, I'd suggest you don't, because there is a big flow on.
There is. I mean, even if your kids, let's say you've got a couple of, at some point, if they want to, leave the nest, they're more than likely going to live in an apartment in a big city for a while, right? So it's important for them as well. So the big changes that took shape is that it's a very, very slow process to get approvals 20 years ago, right? And the problem with that meant that the demand wasn't coming online quick enough. Sorry, demand was high and supply wasn't coming online quick enough, right? So there was a significant alteration that took place, which was they decided to have private building surveyors or certifiers. So depending on which state you're in, and this is why it becomes an interesting conversation, right? Because every state and territory, lands titles and land law is all state-based or territory-based, so that's a problem. So what we got was the governments of the day set the planning approval process, and then effectively these private surveyors or private certifiers, if they built inside that envelope, could approve the plans and permits for a particular build. Okay.
So they're going to get stamped, they can get the titles issued, they can get their funding, and all of a sudden they can sell.
And so in every location in Australia, you have what is the usable airspace. So in some streets, you can go up to 20 stories. If you want to go outside of that, then you effectively have to submit an approval for that to occur. Now, if we're talking about extreme high rises, that would normally go to the planning minister in each state or territory. and they would do an exemption, okay, as opposed to what it is. So, and those things can take years and there can be a lot of appeals, and you go through the building commission. So in Victoria, it's VCAT. Those types of things take sake. So if you want to go outside of the building guidelines and the envelope, then chances are you're going to have to submit your plans, handle all the objections from those people who disagree with the building, etc., etc., etc. Now, so what that meant is we did see the ability to approve things quicker, and there's no better state of that example as in Queensland. The approval process seems to be easier in that state, and that's why we've had this sort of mini building boom in the medium and high density because they've made that process easier. So that's one part of it. Now, what's the flow-on effect of that? The flow-on effect of that is the developers secure the land, and then they look to maximise their profitability on that development, whilst also trying to provide the best amenity they can to the right audience to get the right price. And that's challenging, right? So they'll engage the architects, the engineers, and those types of people to potentially formalise that. They then get the approval, they've got all of that, and now they go and tender that out to a builder. And they'll get maybe 2 or 3 building companies to tender that. So if the building company comes in with a pretty low price, that's more profit for the developer. So if it's more profit for the developer, are they going to be tempted by going with that builder that can do it cheaper than the other 2 quotes or 3 quotes or whatever that they got? And let's say they don't go for the cheapest, but they go for the mid-range one. Now that builder wins that tender. Now they've realised in winning that tender that they might be running on tight margins, right? So what do? What are they looking to do in terms of trying to get the costs down so they can also, as a builder, make a profit? That's why they're in the business of doing this. So what happens then is throughout the building process, you can bring in people who can potentially manage that project. So over the last 15 years, we've had this concept of basically project managers. And these project managers have developed, and they've also come in and says, I know what the architect wants, I know what the engineer says, but I'm a project manager, so I've got a bit of an understanding of it, but I reckon I could do it cheaper for you. And so all of a sudden they go, well, that's appealing. How would you be able to do that? Well, maybe if we adjusted the vent work, maybe if we did this, maybe if we did that, we could, reduce the price. Maybe, Bryce, if we got the cladding from overseas and we brought that cladding into Australia, that could also be cheaper than the cladding we could buy here, right? And that's, what we're going to talk about
some challenges
too,
around
right?
that, yep.
So that's the story that goes on. And what happens is, when it is obviously profit driven, you have a challenge around this. Okay, so it's in the past, quality and speed weren't, they're opposites, right? So if you could deliver a high quality property that's really well built versus speed and profit, and that's what we've had. So we've moved away from quality into a more speed and profit type story, and that's problematic. And so we have a regulator in every state and territory that basically oversees the building surveyors and so forth. But the challenge with that is, and we've seen examples, I think Ross Greenwood should be acknowledged for the work he's been doing in regards to bringing these people to light. And they're telling the stories. I'm a building surveyor, I'm a building certifier. I go in and see all the defects in the building and I say, I'm not approving any of this. And then they go and get someone else to come in who might certify it, right? And so all of a sudden, that because there's millions of dollars potentially in rectification works. So that's problematic.
Yeah, because as you say, the challenge is that the certifiers are now running into a problem because the profession, they have to have professional indemnity insurance to actually run a business. And you're quite right, Ross Greenwood has been at the forefront of that. And someone wrote in and said that their premiums jumped from, I think it was $18,000 to over $220,000, which means that it puts that person out of business. They can't get their job done. And so all around the country, you can't get people that are able to certify these buildings. Therefore, what he was talking about, and I think it's very important, which is why I said at the top, people should listen to this, is because even if you're not interested in that segment of the market, if that causes that particular segment of the property market to slow down, that has huge multiplier ramifications into the economy, because if people aren't building, that's heaps of jobs, it's a very large percentage of our workforce. So the fact that if people can't certify these jobs, they can't get their jobs done, all these certifiers are going out of business. So it was interesting that in Queensland, what they've done to get around that is they've guaranteed, well, they've got the surveyors in other states and in Queensland it's a certified, but what they've said to them is, hey, listen, you guys can get your job done, but what they will do is the Queensland government is now saying the cladding scenario that you talked about before, that will no longer be the case. We will implement a law that says you cannot do that. So therefore, we will give you professional indemnity insurance that has an exemption around cladding so that you can still get on with your job, which is good news for that state. But the thing
well, there's two states that we do know of, Bryce, Victoria and Queensland.
Where it's not the case.
If you couldn't get the indemnity, you can't do your job.
And the insurers have tapped out of the market,
there's no one available. So I think we'll see some changes there, and I know that the Federal Minister is calling a meeting in the next couple of weeks, and they're going to go through that. But it has reached a crisis point, and the last thing we want to see is a crisis of confidence for those people who do want to live in those types of accommodation, right? And I mean, as a renter, you don't have to worry about the repairs and all of those types of things.
But you do worry about your safety.
Correct. You've got to enjoy your amenity, right? And so that's true as well. So that's why for us, it's another interesting reason, and we'll do more of these as we go through today's podcast around, why we still always think it's challenging to buy these types of assets to get a return. So that's the structural challenge, right? And that's the consequences of that is that the industry is effectively gridlocked in terms of regulation and insurance and all of those types of things. The other big thing, in terms of the second most important thing is actually fire. So because fire is, and we talked about that with the cladding piece and we talked about those two buildings, but that's the number two problem, right, in terms of big picture story. And 730 program ran an interesting story about one of the buildings in Melbourne where they just haven't repaired it. So the fire started and they've got this, and it's like $8 million to completely refix all of the building, right? And the builder's gone broke, right? So the builder's gone broke because this is the other challenge we have in this space, right? And we'll give some tips in a minute in terms of what to look to avoid and know the types of quality builders who are out there and the quality developers who are out there. But they've washed their hands of it. They're in liquidation. So effectively there's, it's a bit of a tourist attraction. People are coming past and seeing this patch of a building that's basically, they've ripped off all the old cladding and all you can see is just the framing there. And so no one's living in that apartment, but it's $8 million. Who has to pay for that? The owners.
The owners, through a special levy that they've got to raise that they probably haven't planned for, and it's going to be significant. And,
correct.
If they don't have equity in the home, they can't fund it. Yeah,
So absolutely, fire is a large one, and no one really understood the issue of cladding up until sort of the last 2 or 3 years, and obviously, I think Granville was the big fire in the UK, and that focused in on that. So hence why the insurers are now petrified in terms of providing the indemnity, because these things, when they pay, happy to take the premiums, but not necessarily happy to pay out.
Well, it sounds like they're pricing their premiums in a way that they're not happy to take the premiums anymore, because they're effectively saying, we won't not give you the business, but we'll make it so prohibitive that you won't actually take it up.
Yeah, and you imagine if your premium did go from 20 grand to 220 or whatever, right? Yeah, it's like, you're going to have to pass that cost on to everyone. So who end up ultimately pays?
Yeah, the consumer.
The consumer does. So it's passed on. They pass it on to the builder pass on to it's just a mess.
Just think about that premium change. Like that's a couple of hundred.
It's ridiculous.
The owner of that business is probably earning less than that as part of their the dividend that they receive. So it just makes it not worthwhile, right? So it's challenging.
And some of the fines that some of the independent private building surveyors and certifiers, I've read some fines. I mean, if you get it wrong, even just on a two-storey house, you can get a $30,000 fine very quickly in terms of, no, that was outside of spec, that was outside of reg, you approved it, we've found out about it, you're going to get a little, whack on the wrist and, cut a check for us, right? So, but the regulators do have a role to play. The government absolutely has a role to play because they're the cops on the beat. So if there's not enough of them to be out there doing random audits of the quality of construction and then seeing what the certifier or the surveyor is doing. So I think that's going to be part of the solution, right? Similar to the one we've seen in terms of, improving surveillance on what's going on, because they should know that this building isn't quite coming out of the ground properly, the concrete work looks a little bit, and then, the other challenge you have is, in a lot of cases, there's still some self-certifying going on. So if I do put all of the heating and cooling ducts in, And I self-certify. I say, is that up to? Yep. And you certify yourself, and then you give it to the building. And well, if he's certified it, then he's happy with it. I'm happy with it. So there's a bit of work that needs to be done there. So
it's structural integrity,
yep.
fire damage, and the third one is water damage. So
Yep.
can I give you an example of the water damage? Because that is more common than people want to think. The Property Observer reported recently that there's an apartment block in Zetland that's been vacant for 8 months due to building defects emanating from a leaking roof. Now, I've got a property that's experienced that, Ben, and the challenge, as you know, is water runs. It leaks over there and it runs all along.
It finds its own course.
Water finds its own level.
I've got 2 properties in my portfolio, Bryce, that I've had water issues. I've got a private terrace on one, and our new property in Moonee Ponds, where we've got a data room, which is the smart house. Well, water's getting in because it's under the patio, right? So the balcony. Oh, no. So we're getting water in there, right? And that's a build in the last 18 months. So there's tens of thousands of examples where little things like the waterproofing of the flat above, they've got cracks in the tiles and that water's coming down, damp, mold, all of these types of things. So if there was one that I'm looking for in terms of, even though it's a great building or whatever, I would always be looking at that because it's expensive, right? You've got to rip. How do you find the leaks? They're not easy to find when it comes to those.
It's a big one for me too, Ben, because mould is an issue for our family. We've actually had to move houses because of mould, and with my youngest son and my wife, and so that is a massive health risk, and don't get me started on that. So I guess if those are a few things that people need to consider. Here's some of the research that people need to be thinking about if they do want to buy some of these buildings. Because I think the important point to consider here, you talked about it, you touched on already, not all buildings are rubbish, all right? There's been buildings that have been around.
Fine, right?
That's right. So we're talking about the outliers, but it's a confidence issue with these outliers that are coming up. But a couple of things. When you are wanting to buy something like this, you've got to investigate the design and the documentation. So the best thing to do is find out who is actually going to build this particular property, and not only that, have they got a track record, and have they done anything before, and has it stood the test of time? Because the basics of business are that two entities can make decisions. A human being can make a decision, and a company can make a decision. A trust can't make a decision, but a company can. But what that does is affords them legal protections that you need to be aware of. Don't be naive to that. So if you are buying from a company that has a silo company that doesn't have any trading history and they've got a history of jumping, just be aware that there's very little protection that happens if something happens, you talked about it before, liquidating. So make sure you know who you're dealing with and go and have a look at some of the projects they've done in the past, and maybe just have a chat to some of the people that have been involved in some of the projects in the past, because they'll be prepared to tell you.
I agree, Bryce. I mean, the thing for me is, like, if I was looking at it, normally if it's off the plan, they're going to say architecturally designed by X. Right, well, what's the first thing I'm going to do? I'm going to go to that architecture, I'm going to go to their website, and it should have a series of all of the projects and developments that they've done, that they've been involved in, some of the awards that they've won. If I don't have any of that and it's a Lego land building, then I mean, you know what we feel about those buildings. They are shocking investments. They are terrible. It is just mass-produced rubbish. Yeah. So if you're ever going to be looking at, what makes for a building that could get capital growth, if the architect is an award-winning architect and it's quite uniquely designed. It needs some
uniqueness about it.
Yeah, owner-occupier appeal built all around that.
Because we get people writing into us and say, you guys are so anti off the plan. Well, because 99% of it we are, and we are the first to admit there are some exceptions. Yep. Absolutely, there are some exceptions.
And if they're a public, like, so the developer can sometimes be a public company. How are they going? How are their profits? Are they building in that company name, or have they set up a silo company in the event of issues? Now, we have seen Canberra's also been experiencing some fast builds for profit driven. And the challenge with those guys, one of them made good. Right, so it was a national company, and it was an $8 million remediation work that needed to be done. So the challenge with that was they came good. So that's where you want. It's like, all right, we've made a mistake here. We've done it, or our builder's done it, or whatever. That's the big bit. So you've got, remember, you get the architecture, you look at the plans, and you look at the builder, and you look at the developer. Have they got a proven track record? Is everyone happy with that? You get through that stage, and that's the first thing.
And the second thing, Ben, is to realise that after you've moved in, everything's shiny, the carpet smells great, the taps are looking awesome, what are the ongoing costs to live in these properties? Because they can be, you can have a fully paid off apartment, Ben, and be paying costs that still make you feel like you've got a mortgage. Because one of the things as an investor, I always say to people that if you're buying something that has got a body corporate involved, whether it's a townhouse or whether it's an apartment or whatever, always look for the rent return after body corporate spend so that you get some parity of comparison, because you might have something in the same street, around the same price, getting the same rent, but the rental yield back to you can be really significantly different because one has got an exorbitant body corporate. Or on the positive side, you might have one of the body corporates that are actually being proactive. They've thought 10 years in advance. They've actually got a capital works program in place, and they've put it in place so that they start to build up some of that sinking fund so that they don't have to go back to the owners later and say, oh look, we need you to do some maintenance on the building. So there's this balancing act too, because what happens is if I'm an owner and I've been contributing to that sinking fund, as soon as I sell it, I've got no access to that. It's an asset of the building. It's not an asset to you, even though you've been contributing to it. So it's a delicate act of making sure you get the optimum there.
Oh mate, I think well summarised. The next one we want to look at is in terms of the guarantees, right? So you mentioned it earlier around what's involved in that process, and I think it's when I'm sitting down and if I'm thinking I'm going to buy something off the plan, it's like what insurance policy are you going to give me? What is the builder's warranty? What are the developers willing to give me more confidence around that? I'd even be arguing in these current times you could potentially even get a guarantee or try in your negotiations for buying price guarantee. So in other words, if I buy this today and it doesn't stack up in terms of a bank valuation in 18 months' time, will I be able to void my contract? Now,
you'll start to see some whites in some eyes.
Yeah, you will. But that's if they are supremely confident,
you bet.
Then they should do that, right? I mean, I've been advocating that for a long time. I mean, I don't like the idea that someone pays $680,000 for an apartment and then at completion it vals up at $600,000. There's $80,000 in paper losses. I don't think that's fair and reasonable, right? So, if you and the buyer at the moment is in a position of strength, there's a lot of supply of apartments out there. So, if you want to win my business, then ultimately, these are the types of negotiations that we can do.
Yes, Ben, I agree, mate. So that's if you could. I guess the other thing that people need to be aware of too, if it's off the plan, is on what you just said. Let's say I bought something outside of the median. Let's say I bought something that was really great and it was a little bit higher and it's above the median, and we're starting to pay 7 figures and multiple 7 figures for these properties. The challenge is if you bought it in, and a lot of Sydney people did through the boom, they were buying these really great properties. Then when it came time to settle, they had challenges with bank val because the bank had valued it low. And all of a sudden they're going, oh, well, I can't settle. And the bank's gone, well, we'll only give you 80% or 90% of the valuation, not of your contract price. And there's this gap that they've just got to tip in the cash.
Yeah.
And that is a recipe of stomach ulcers, sleepless nights, enormous stress, and relationship problems, because you put yourself under that pressure, Ben. Not many relationships can withstand that pressure and that intensity.
So if you find yourself in that situation, we've on other podcasts we've talked about what are horror stories like that. One of the other things that you could also look to do is approach the selling agent and the developer, because ultimately they don't want to see you rescind either, because the cost of potentially suing you and going after that and the whole bit is problematic for them. So you may be able to renegotiate, Bryce. It's almost like I can't complete on this. So they'd probably still happily take the 600 as opposed to the 680, because it's one. They've got to repay all the money. They've got to get that money back in their pocket. So I have heard of stories where there has been some purchasers who have been able to sort of say, let's come to the party together here. Now, I need a valuation of 620 as a minimum to be able to get my overline. It's come in at 600, so maybe I paid 680. Let's adjust that down to 660, all right, and then we get the job done, right? So I mean, it's not ideal, but it's still better than you losing the 10% deposit and you get no money and the risk of being sued for further funds if you can't complete on that transaction. I mean, you know what we're like. I mean, we are on record as saying, in theory, 99 out of 100 times, we would never, ever encourage anyone to buy off the plan.
Correct.
It just does not work.
Well, don't take the risk. We want some history. We
Yeah,
want to see a bit of a track record. Don't take the risk. I'll give you a reason why you need to see that, folks. I was involved early on in my professional life where we had moved, let me think this through, I think it was 30 apartments on the Gold Coast. I was part of, I'm on record as saying I was a project marketer, so I know this space intimately. And what happened is we'd pre-sold, when I say we, I was involved in a company that had pre-sold all of those apartments, but then the developer realised he wasn't making enough profit. So what he did is he went and I
sunset clause.
Well,
action, or what are they?
So the sunset clause is one part. I've got a story around that, but this one, they just went, it was in Chevron Renaissance, so I remember where the architect was, and they went in there and they said, well, we're not making enough profit, and they go, don't worry about it, look at this, and he gets the button, he goes, just shrunk everything by 15%. And he goes, you got your profit back. So what the people had signed up for,
oh goodness, yeah,
off the plan, then what they got delivered was 15% smaller, but it was across the group, just everything just gets diminished by 15%.
So, and so hence in the contract, it would have given them the provision to be able to adjust up to 15 or 20.
If anyone listening to this has not seen an off-the-plan contract,
yeah,
it is right up there with the Tax Act, the Bible, War and Peace. It is thick, right?
Yep.
So in there, it is written by the seller for the best interest of the seller. That's not in the best interest of the buyer, and there is always a clause that says that they can go and press a button and drop everything by 15%.
Wow. So caveat emptor. So they're the sort of things you need to, basically don't sign up to any of these types of properties that are going to be built with the right for the developer to change. Because there's nothing better than walking into the display box, because that's what they are. Normally they're just a display box. Sometimes they're containers that are fitted out. Right? You're walking in downtown Melbourne.
So one the other day it was like a crane, right? So they walk you up the stairs and then you get up into this box that's in the end. Goes, have a look at the view. You're like going to extraordinary.
So they'll play to their strengths, which they should. That's exactly part of their job.
That's selling.
But yeah, it's like, oh, look at the space and all that. But the fact that, wow, 15% shrinking.
Bang, just with the button, everything. Jeez. Everything just diminished by 15%.
There's the profit.
The other one you talked about is, and I've talked about this before, so I won't go on too much, but the sunset clause, which is essentially on the flip side, Ben, when everything's going wonderfully well.
Prices are rising.
The developer then they've got this sunset clause where it says if the titles haven't been issued by this date, either party, this is how they make it sound nice, either party has the right to rescind the contract. So when the market is flying, which was back in 2003 when I experienced this personally, what had happened is I was a project marketer, I'll fully disclose it, I got paid by the developer, and what the developer did is they gave me 50% of the commission, Ben, up front, as soon as the property went unconditional. And I couldn't get it fully unconditional, but I could get it unconditional to the point subject to valuation, right? But in those times it was fine. So they paid 50%. And then the market had flown so much that they enacted the sunset clause. And here's the deal, they said, you just keep the 50%. We don't even want to come back to you for getting that back. So then they
because we can now pay, we can make another $50,000 on every apartment that we're selling.
Yep. So our buyers, that was like the biggest lesson I've ever had in property right then, because mate, I had to then get on a plane to every single client and eyeball them, and that was painful, and that was the start of the beginning of the end for me for being involved in that.
Well, and look, we have seen movement in that space around sunset clauses because they basically are agreed clause when they're enacted that way. So there's less ability for developers in some states. Queensland, I know, have tightened that up a little bit because it was just too much in the advantage of the seller and the promoter, the developer. So that's interesting. Now, let's move on to the existing buildings, Bryce. So we've really, let's summarise those just quickly again for those who are buying off the plan.
So the research, you go and investigate the design and the documentation to make sure it was done by a reputable company. Go and have a look at the past track record of the developer and the builder.
How well funded the builders are, reputation, all of those things.
Project. The guarantees that you talked about before, see if you can see the whites in their eyes, that'll be a bit of fun. And then really research what the ongoing costs are going to be if you want to be in that building. You're right, existing. We are comfortable.
We are very
to consider existing buildings because we then have track record, we've got history, we can see the test of time does a lot of the intel for us because if it's been around since the 60s or the 70s or in some case the decos, the 30s and the 40s and the 50s, That actually is a little bit of intel that you can't deny, right?
Correct. And we are big fans of land to asset ratio, meaning that we like smaller developments because we get most of our security in the land value, as opposed to high rises. We don't have that security because it's shared amongst 1/200th as opposed to 1/8 as an example.
And back in the time, Ben, that was the high rise of the time because everyone was so used to having house and land, and then all of a sudden in this beautiful street in Elwood or a beautiful street in Hawthorne in Brisbane or West Perth or all around the country, all of a sudden these 3-level walk-ups came up and everyone's gone, oh, that's something unique and different.
But they allow me to buy in a good location, so I had all the amenity.
What's
and
important,
the
isn't it, Ben? It wasn't on the main strips. It was in beautiful streets. You just drive around Hawthorne or Bulimba or Norman Park in Brisbane or all around the North Shore of Sydney.
Or the Leafy East here in Melbourne, wherever it is. Right?
You've got some amazing buildings in some amazing streets, but the stuff that's getting built now is on major roads, often on corners of major roads. So, first of all, you want to see that you've got track record. 2, you're getting these established buildings, but you're also they're more desirable because they are the older buildings. So some would say they're a bit uglier,
but good footprint.
And they've built them. The size is internally bigger. They've got the hallways down the middle. Their floor plans are. They've got a central toilet. They've got a nice balcony that doesn't look over like a fishbowl. So
low ongoing costs.
And that's the important thing, isn't it?
That is
no pool, no caretaker, no lift.
The rent comes to you, not to paying for the building to be continually maintained.
If anyone's heard the origins of my investing story, Ben, my first investment property, I had a lift, I had a pool, and I got on so
not
I
even your blog.
That's right. I got the privilege, Ben. I got the privilege of paying for a lift, and I didn't even get to use it. That was the kicker. So
I love that.
I've made a few mistakes in my portfolio. I'm not afraid to say that. But
so what's the DD? What's the due diligence we need to do, Bryce? What's the number one thing?
Number one due diligence is you go and have a look at the past track record of body corporate minutes, because what does that tell you? You've got a community of people coming together as a community saying the body corporate's got a responsibility for X, Y, and Z, and if there's something wrong with the building, they're going to let you know. Or if there's something wrong with a defect or a person who's living there or something that is affecting the peaceful enjoyment of that community, it is usually going to be in those minutes. And I would go back as many as you can possibly get your hands on, minimum 2, but it'd be nice to see 3 so you can see if there's anything back in the past where there might have been an issue. Now, I've got a beware on that bit, because based on what we've been talking about today,
yes,
would there be an incentive, Ben? Would there be an incentive for
the body corporate not to disclose, Bryce?
Correct.
Yes.
Because what's one of the biggest challenges that you're going to have with the current issue around the crisis is people protecting the value of their asset. And how do they protect the value of their asset? They have an off-record chat, Ben, about some issues that they do not put on the minutes because they know this is what the diligent people will do. But first of all, that's what I would do, Ben, notwithstanding there's an issue. And secondly, I talked about it before, but do you have a body corporate that is proactive about realising that a building will need some maintenance done? And are they going to be reactive or proactive? And reactive means that they will just deal with stuff as it happens, versus people who go, hey, here's our 10-year maintenance plan, here's that divided by 10, here's that divided by the 18, the 16, the 12, the 8 owners, here's your contribution each year, so that you make that. Have they got a sinking fund balance for a rainy day?
A healthy sinking fund balance is a good sign of a couple of things, Bryce. A well-built building as well. Because if they haven't had to do anything, and I'll give you a good example. Where was I? I was in Brisbane, and I was looking for an apartment for a client of ours, and I came across this one in about 6 kilometres out of Brisbane, and I went and had a look at it. And I thought, okay, it's really well priced, good floor plan. I did notice a couple of cracks, so I'm like, okay. So everyone goes, well, can you still get a building and pest inspection on the building? And I said, yes, you can. And you can even get them on high rises. Now, some building and pest inspectors will say there's a limited scope in terms of the external work they do, especially if it's 20 or 30 stories. They're not going to be able to get up on a scaffold and go and have a look at it. but they can still do the underground car parks. They can still do, because most stuff comes from the foundation and works up. So in this particular case, I got a building and pest inspection done, and it was like, a couple of cracks there I'd like an engineer to have a look at. As soon as he said that, I said, no, don't even worry about it. As soon as I'm out. That's it, I'm moving on to the next block, because as soon as so you can pay $400, $500, $600 and you get that, and then all of a sudden it's like, okay, if that's worse than I thought it was, because it's structural in an area, I'm like, I don't even need to engage an engineer. I'm not going to buy that for my client. It's like, next property please, even though that I thought it was a good buy, I'm moving on.
That's what we call self-selection. That
just helped us out. I don't need to pay just $2,000 for the engineer to tell me what's good or bad about it.
Yeah, so there you go, folks. And the last one is, I apply this particular one, Ben, even if it's a house, if it's a townhouse, I go and talk to the neighbours.
Yeah.
And because they are only too willing to tell you.
Well, it comes back to that story about whether the body corporate is fully disclosing, right? So if you are buying into a medium density for whatever, because again, owner-occupiers could be listening to this saying, I do want to live here, and that is the price point to get me into that suburb, and there are lots of apartments with 30 or 40 apartments in them now, so go and door knock. And you know how they've still got the security that you can't get through the front door? Just door stop them. I've done it before. My doorstop is, excuse me, do you live here?
But what happens if you're not a Collingwood supporter and you sort of...
There's a nice way of doing it, and here's the approach. It is as simple as, hi. Because what they do is, do you need to get in? And it's like, no, actually, I'm interested in apartment number 31.
Yeah.
But I would love to have a chat with you. Do you own or rent here?
Oh, you're buying the one that Jesse's divorcing, you know.
Thank you. Nice bit of information.
Yeah.
Oh, lovely couple. Didn't know what happened there. And especially the old folk who have been in the building forever. You could have, some of them ask you up for a cup of tea.
Yeah.
Or would you like to come up and have a look at my place as well? Actually, are you a buyer's aid? Or you can probably value, what is my property worth?
Yeah, well.
You get the whole thing right. So. And are you on the body corp? Oh, you're on the body corporate. What's happening? Oh, it's unbelievable. Right? And I would door
scone and your tea.
3 or 4 people
Yep.
To get the information that I need to get to, because they'd be the owners corporation do nothing for us.
That could cause a crisis, Ben, because people are wondering if they're going to buy this, they might get stopped by you for a little chat. They might not buy anymore. So yeah, I reckon that's really good stuff, Ben. Hey, we put a shout out to Facebook asking if anyone had any questions around apartments. We're getting pretty close to wanting to wrap up, but I thought we might try and do.
Yeah.
And this is a challenge for you. We're going to try and fire through as many as we can.
Yep.
But I believe in you, mate. You've got a sore. You've been coughing a bit, so I reckon you could probably.
Let's go.
The challenge.
What do we got?
Number 1. This is from Karen Lee. What to do with an apartment you bought prior to finding your podcast?
Yeah.
Okay.
Seller hold report.
Seller hold report.
So I know that's a bit of a blatant plug, but the reality is if you're in an oversupplied area, you might need to look at opportunity cost and recycle that one.
Yeah. This one's from Sabrina. I want to know if it's worth buying off the planned townhouse in Deanside, which is next to Caroline Springs here in Melbourne. 3-bedroom townhouse, no body corporate, under 390. I'll answer that. Very difficult to answer with at that point, but what I would say is I do know that it's pretty normal because there's a lot of land out there to buy a house and land out there. So I would want to look under the bonnet a bit more on that. This one's from Jake Lehman. Things to consider in regards to the sinking fund, or if how the body corporate requests to raise money from owners for certain issues. Keep up the good work. I think we covered that one, Ben.
Yep.
Rory Benjamin. I have an old apartment around the 60s, bought it in December 2013. Since then I've put in a new carpet and vinyl. Should I get a depreciation schedule in it?
So if you've put those in, you don't necessarily need to get a full schedule done. I would still say to you, it's worth a phone call.
I would say
to a quantity surveyor. We recommend BMT.
We'll put a link in the show notes, Ben, because you can actually get a discount if you mention the property couch.
Yes. So but they'll say, look, if it's 2 things, that's not it. That's not going to be enough.
But they bought it in 2013, so you could get all the capital works and any other depreciation. That's prior to the change.
But it's built around the 60s.
Yeah.
So that's
but there's stuff that might have been done on it since the 60s.
True.
Since 1985 is what you're referring to.
Had a new roof on it, anything like that.
So we're in agreement. I reckon the answer is maybe.
Just make the call.
Make the call. So, Tanya Aitken, what are some of the unexpected costs of buying, hold an apartment? All right. Pool, caretaker, lift, concierge, sinking fund contributions.
Window cleaning. Painting. Painting a 30-storey building. The lifts, you're saying, the cabling, that's got to be...
So Tanya, you could have fully paid off an apartment and still be paying quite an expensive amount per month.
Yeah.
So look under the bonnet on that. Nicholas Conroy, how do you determine capital growth on an apartment if you are the second purchase, assuming that the original price has been inflated for developer costs and not an accurate figure?
Oh, great question.
It's a bit difficult, but what you need to do is actually work out if what you paid you think is market, and then go back and have a look at the same time that you purchase what other ones are doing, so that you can try and get a benchmark for what you think the market was supporting for properties that had second and subsequent purchases for similar properties, so that you can get a reference. Because you are right, you've got loaded marketing costs, loaded builders' profits, loaded
It's a lot easier. It's a lot easier when you're in a bigger apartment block, because there's probably quite a few recent resales. And then you'll pretty much know, if you're landing around the same price as that's where the market's at, right? So the market will always find its value based on recent activity. So if it's a small block, it's a little bit harder. You need to probably look at the comparable properties within 500 metres.
Well said, mate. Sonia Malia, with a budget of 700 to 800, I'd like to know if an apartment, not brand new in Moonee Ponds, careful mate, is a better buy than a house on 700 square metre block in Glenroy as a comparison apartment versus house. Thank you. So I should declare Ben lives in Moonee Ponds, so this could be a tainted view from him. I'd like to look under the bonnet on both of those, but at face value, I would prefer to go for the land.
I'd go for Glenroy because it's not too far out. It's fully utilised land.
It's got a train station that goes through there.
Usually the land's big, so it's got
gentrifying nicely.
Go the house and land there. The caveat on the Moonee Ponds would be if it's within sort of 500 metres of the village there's a lot going on in Puckle Street and those stuff, but I'd still probably go the house and land.
Yeah, if you're close to the palace, i.e. the Kingsley household, you might
not the palace,
lift
palace,
the value. Brian, is it safe to buy now in Brisbane apartments, given lots of the newer builds have dropped 20% in price, or do you think it's still overpriced? I'll say that it's still not, in that particular market, house still dominates over medium and high density. Even though they've dropped in price, you will still be incurring some of these expenses that come from being in these larger buildings. So I would still say it is at best an amber light on apartments, but I'd still call it a red light.
You could pick the eyes out of a great apartment, say in Ascot or somewhere where you're thinking longer term, and great value, low maintenance, but in general terms, amber.
Laura Mahoney, I want to know if it's worth buying an apartment as an investment versus a house. If Laura, this is very difficult to answer because all things being equal, you chase the house because it has the land. But if you don't have the opportunity through your budget to do that, what you have a decision is, do you go further out or do you stay closer in for the land value? So if the apartment was in an area that was scarce on apartments, had great amenities, had great land value versus being in the boondocks, I would say that would be a chance for you to consider an apartment versus a house. Or you might be in Perth, where the market has absolutely been not forgiving for you, right?
Have you been reading my Did You Know, Bryce?
Oh,
so I've got a little bit of okay.
So here we go, Laura. If you were in Sydney, where that market is the most mature apartment market in the country, and it meant that you could be in close to the city, had a train and the amenities, that might be a good thing versus the house that's way out in an hour and a half sort of commute town. But if you're in Brisbane or if you're in Perth or you're in Adelaide, Brisbane is the second most mature market. So I have given a politician's answer there, Ben.
No, it's case by case.
But Laura, I would say to you that I think Sydney's mature. I think there's opportunity in some apartments, established old school apartments in Melbourne, in certain parts, just because of sheer affordability and the fact that this city is just going to be smashed with more people coming into this part. But other parts of the country,
pass.
Yes. Here you go, Ben. Mary Perkins, this is a layup for you. Whether the ugly 60s, 70s brick monsters are a good investment, so you can protect yourself from the Opal Tower situation.
Yeah, well, I think you've just answered your own question there. Yes, we think they are. And we think the back testing on those apartments, the resale, the proven capital growth analysis that you can do on those, it's pretty easy to work out how well they grow. And then as the ones next door or down the road potentially get bowled over in the next 10 or 20 years and get sort of 10-story buildings put next to you, that is going to drag up the value of your asset there as well.
And the last one, Ben, is from Stamati, Papa Stamatis. Sorry if I butchered that, Stamati, but very simply, just don't do it.
Just don't do apartments. But yeah, look, some, absolutely. That's exactly
Ben, I'm proud of you. We got through all of those questions.
There we go.
You fulfilled the mission. You should turn up with a cold every week so that we can get through so many more questions. No, that's not true. That's not true. It was only serious. All right, Ben, I am going to give you my life hack today if I can just find my notes, Ben. So this one's from SpeakPipe.
Yep.
And it's from Alistair. And Alistair is someone who's come here before, but I think it's a good one. Check this out.
Hi, Bryce, Ben, and Ivis. Thanks again for your great work. Alistair here again. My money-saving tip would be car hire. So most of us think that we need a car. Maybe you do, maybe you don't, but maybe the second car is the most negotiable. So myself, we don't actually own a car because we live in the city and we don't need it. But from calculations, we worked out that the cost of one car, is equal to car hire for 5 days, a fortnight. So if you have a second car that you're using for less than 5 days, a fortnight, maybe you should investigate car hire instead.
That wasn't bad.
Very clever.
Very clever.
And that's true. I mean, we've got clients who live in a city, Melbourne, who just Uber.
Yeah.
They just move around because $40,000 car, $50,000, that's cash tied up. That could be sitting in your offset
account.
If you're only using it ad hoc and so your Uber's costing you $60 or $80 a week and getting around, mate, that's cheap. Right? So I like it. So thank you very much for that, Alistair.
Did you know?
Did you know, Bryce? So this week we saw CoreLogic release its Pain and Gain quarterly report. Our good friends at CoreLogic there, Tim Lawless and Cameron Kusher, in terms of the work they did. So here we go, because it was an interesting one, right? And we've still got this lag data coming through, so I've got to keep reminding people. When you're reading and listening to the media today about the economy, a lot of the information you're getting on the economy is now 3 months or 6 months old, right? So they're still milking this idea that we're going to be in a recession, which I completely disagree with. Anyway, 12% of Australia's properties were resold at a loss compared to what the seller had paid for them. So in other words, how this works is when you bought it, they get the valuation, and then when you sell it, they get the revaluation on it. So that was interesting. For the first quarter of 2019, 12%. Australia had a total of 486.8 million in realised gross losses. 486 million over the March quarter. That's the highest share of losses nationally seen. And coming back to Perth, unfortunately, Perth led the charge. 24.8, so almost.
Sorry, Mum. Sorry, Dad.
1 in 4 experienced a loss from the time they bought it. Sydney second at 19.9%. So basically 1 in 5, said Cameron Kusher. In terms of on the flip side, and this is where I remember I just said 486 million.
On the down.
On the down, we only made a lazy $14.3 billion in gross profits earned by those who had bought and then sold in the future. So that is telling you that story. Now, obviously, that means that they could have bought a long, long time ago, but not a bad little return, 14.3 billion. In Australian dollar terms, Australia's most expensive cities, Sydney, 24.3% got the big profit, and also Melbourne at 23.5% got those big profits.
That's annoying for the Sydney versus Melbourne folks, isn't it? That was so close.
They've had some big growth. Now, so let's go down into the investor level, and then I'm going to finish off with houses versus units to bring it back to the story of today.
I don't think it's a very good outcome for apartments.
Investors were also more likely to resell their properties at a loss.
Come on,
compared to owner-occupiers. Why do we do this podcast, Bryce? We do this podcast because most people buy crap. Most people buy the rubbish. So in the first quarter, 10.5% of properties owned by owner-occupiers were sold at a loss, compared to 16.7% for investment properties. People are still getting advice from spruikers. Stop getting advice from spruikers.
Stop it.
These people that are telling you, is it a good investment? It's not going to be a good investment. Buy existing, don't buy new. Investors across capital shitties.
You allowed to say that?
Capital shitties. The share of properties resold at a loss varied significantly. In Sydney, 9%. In Melbourne, so this is investors, 9% in Sydney even after a boom. That's still not good enough. Melbourne 6.4, Brisbane 11.5, Adelaide 8.4, Hobart 2.1, and Canberra 10.2%.
Now take it easy, mate. You haven't mentioned Perth, so I'm worried about what's coming. Take it easy.
Meanwhile, in downtown Perth
Right.
and Darwin,
Come on, Perth.
32.8% of investors.
Come on.
And Darwin, 45.5% recorded
See why you
losses.
dropped your voice. Yeah, that's important.
All right, now
Good
houses
change.
versus apartments. CoreLogic said that apartments were much more likely to resell at a loss compared to houses.
Well, knock me over with a
Now,
fella.
Cameron, if you're listening to this, because I've always asked CoreLogic to try and work out the brand new off the plan ones, because we've had our
Yes,
good friends at
versus the
BIS
established,
Oxford.
yes.
They told us exactly how many of the off the plan apartments. Horrible, wasn't it? Remember, it was horrible.
Yes.
So during the March quarter, the portion of loss-making apartments, 20.5%, far exceeded the number of houses that sold at a loss, which was 9.5%. I'm dropping the mic.
Drop the mic.
Drop the mic.
Wow. That was a big rap.
There we go, big wrap. That's just nice, sort of woven in there. So what's the takeaway for me, just quickly, Bryce? There is money to be made in apartments if you pick the eyes out of it.
Yes.
There's money to be made in great markets across Australia if you're a borderless investor and you go into the markets where demand and supply is telling you a story that there's opportunity for capital growth today and into the future. That's it.
Mate, good wisdom, and you did that off your deathbed as well.
I
So you
did. I'm
came
off
in
to bed
to
now.
record. You
Yep.
are, so we appreciate that. But there you go, folks. Hopefully that has given you. We haven't talked about off the plan for a little while, mate. It was
No.
fun. And we haven't riffed in the studio, just you and me,
No, it's
for a
been good.
little while. So it's been real fun. So, but stick around, folks. Make sure you tune in the next couple of weeks. We have got some amazing guests lined up. We are not resting on our laurels. We're bringing you the very best minds in the country when it comes to property finance and money management. Ben, until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Couldn't have said it better myself. See you next week, folks. Hey there, folks. Bryce Holdaway here. Before you go, if you're new to our community and only listened to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now, for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarises the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more. And you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.